Welcome. I am Jason Shapiro with Crowd Market Report, and today I have the pleasure of speaking with Siva-Jothy,
That's
who
right.
has a lot of experience in this game. He was a partner and the head of proprietary trading for about 14 years, I believe, um, at Goldman Sachs. Boo. And then he left there and he ran his own macro hedge fund for a number of years. Um, and I'm going to be interested to speak to him about macro investing. He's the first person we've had on here that really does that type of thing. So hopefully we will learn quite a bit. So, Siva, welcome.
Thank you. Thanks for having me, Jason.
Oh, I'm sorry. The name is Christian and the last name is Siva-Jothy.
That's it.
Oh, now I got it. I'm an idiot. I'm sorry. Okay, so we have Christian Siva-Jothy on, and all the things I just said are still just as true. So why don't we go through how you approach this whole thing of trying to make money in this impossible game?
Well, it's interesting you say that because I stopped intraday trading about 2 years ago simply because I was finding it impossible. The last couple of years I've been predominantly more of an investor, but to go back to the beginning. I should probably talk a little bit about actually how I started, if you don't mind, which was at Citibank, which was it's a long story how I got there, but there were a group of four of us with the first graduate intake into Citi, into foreign exchange, I should say, specifically. And I got stuck on the forward cable desk, which was predominantly it's a sort of short-term interest rate desk. I was doing the overnights and Tomnex. A pretty boring job, but it, as luck would have it, it gave me a very good grounding in short-term interest rates. And I think even to this day, actually, there's not that many people that familiar and how spot FX is funded in the overnight or the Tom next, and those rates can generally doesn't do anything, but in times of stress, those rates can go to 5,000, 6,000, 10,000% in the overnight, and it can have a pretty large effect in FX. And I did that for a number of years. But I seem to have some kind of aptitude for positional trading. So Citi moved me over time into more sort of macro stuff. And then eventually I joined GS, and I think it was 91 actually. And I should say, when I started at Citi, it was October 1987. So it was a rather interesting introduction to markets, although the equity markets were flying around and the bond markets were. The FX markets actually didn't do a great deal, but it was instructive for me that when shit hits the fan, that's when the Fed starts cutting rates basically. So that was a lesson I learned pretty early on in my career, and I took that to some degree to GS. I was actually in J. Aaron, which was it was a part of GS, but it was almost a separate company within GS. There was sort of the commodities area, but it did FX, and over time, certainly while I was there, it merged and it became FICC, which is fixed income, currencies and commodities. But actually, oddly enough, even when I became a partner, I was a J. Aaron partner as a subsidiary of Goldman Sachs. And there was almost a slightly different culture actually on the J. Aaron side. It was much more inclined to take risk and became very much sort of the risk-taking part of GS. But to get back to your question, how do we go about it, or how did I go about it? I'm not technical. I do look at charts, look at it for price action more than anything else. Read a lot, and I guess over the years I've developed a style that I look for highly asymmetric trades. I tended to use options a lot. It's probably easier to give you an example, I suppose, than
Please.
Actually, a recent one I think is good in COVID, which was probably that was the last time I think I was probably very actively involved in the markets when when the Chinese essentially started closing down Wuhan and then the surrounding areas, I think you were looking at, millions of people, it was pretty clear to me that something big was going on. Because the Chinese don't do that for, for no reason at all. So I just went to basically my go-to trade, which is either euro dollars or Fed funds. I think it was a Fed funds trade I did actually, and simply loaded up. And very simple, nothing particularly complex about it. At that point in time, it struck me as a pretty asymmetric trade. Rates weren't likely to go up, and if COVID was real, they were going to collapse, which is what they did. That's a very good, simple example of a trade. There, I can give you other more complex ones, but that in essence. And so the role of the group within GS was really to make highly leveraged bets. We weren't intraday traders. We were looking sometimes, as a month to 6 month trades, but trading very infrequently, I'd say. I think I used to joke that, if we caught one trade, that would be a 10% year. If you caught two, it would be a 20% plus. And if you caught three, you were lying.
That's interesting because I think that, that's similar to what my return stream looks like. And I think that that's similar to what, honestly, people that tend to make money over time, return stream looks like, because you're dealing with, as you said, highly asymmetric trades. I think that's the most important thing somebody could find, right? People like to trade all the time and people like to have high hit rates and on all this. But the truth is, 4 good trades a year, if you're doing your risk management right, 3-4 good trades a year is all you really need.
Yeah, and discipline, which unfortunately is something I'm still battling with to this day after 30 plus years. So
yeah, aren't we all? Yeah, I mean the issue is the market's open all the time, markets move all the time, so to have the discipline to sit and wait for highly asymmetric trades is difficult. What do you do with? So okay, I get the COVID one. Buy the short end, because if there's going to be a panic, the short end is going to go up, and if there's not going to be a panic, then it's probably not going to lose you very much. That's fine, and that's sort of a macro type of way of looking for a highly asymmetric trade. But when you're looking for these type of things, are you mostly looking at it from that kind of picture, like a macro picture, or are you because we know that markets are discounting mechanisms, in other words, right? So are you thinking about, hey, I think this, we come into this year, I think that people are now discounting in 6 interest rate cuts, and I don't think that there's going to be that many. Therefore, I'm going to put on a trade. That type of thing?
that would certainly be one way of approaching it, and that's. However, the asymmetry in that isn't attractive enough for me. It's something I certainly might have looked at a few years ago. A lot of it is simply sitting around waiting for something where the market is heavily in one direction. And so I'm not a contrarian, but I do like to have positions where I feel the market is positioned the other way, simply because if you're right, you're going to get a bigger bang for your buck, and that adds to the asymmetry in a way.
So how do you measure that?
Consensus psychology. I mean, it's I was fascinated. I watched one of your videos. It was Annie Duke, and I think psychology plays such an important role in what we do. Psychology, how people, are they bullish, are they bearish, how are they positioned? And if you're spending enough time sitting in front of the screens looking at price action, you get a sense for that. Sometimes the easiest trades, you go with the crowd. I kind of feel very uncomfortable doing that. Sometimes that is the best way to make money, but I'm not very good at that.
Amen to that. No, I'm horrible at it. So really, you're just kind of based on experience and based on feel and listening to what people are saying and watching, you're getting a feel for where consensus is. And then you are looking to hopefully get a great risk reward trade by trying to go against that consensus.
Yeah. I mean,
Although that you say you're not contrarian, but that is what contrarian is.
I don't get into a trade because it's contrary, but it may look more attractive to me because of that. But the fascinating thing I think about markets is they've changed. When I started, people used to look at money supply numbers. They were the numbers that everybody waited for. Now they're not even published anymore. So the market is, it's so dynamic and it's changed. And over 30 years, I've grown older, certainly, and the markets have changed dramatically. The introduction of computerized trading. When I started, there were no PCs, basically. There were no mobile phones. I tell my kids this and they look at me in astonishment, going, how how did you survive? How did you do anything? So
Yeah.
and I do think automated trading, program trading now has such a huge influence and is a big volatility killer. And that's something that I've had to adapt to, basically,
By doing what?
by recognizing, certainly when you're somewhere like GS, you could potentially put on big trades that might affect the market for a few minutes, perhaps a little bit longer. But I think these days that impact is no longer there. I think there's just so much, the volume, the liquidity, certainly the stuff that I trade, and I should have, I generally trade very liquid products. Because one of my risk management tools is simply liquidity. It's not such a big issue for me now anymore because I'm not trading huge size. But it certainly was, 15, 20 years ago. So liquidity was extremely important and was a big part of risk management.
Sure. In a trading size, you can't be in those illiquid markets. Do you find that I've never worked at one of the big investment banks? Um, Clearly, people out there believe that the places, and in particular Goldman Sachs, have, let's call it, better information. Strictly because not strictly because, but one of the reasons being they see flow.
Hmm.
So by seeing flow, that gives you some inherent advantage. Do you believe that? Can you confirm that? Deny that? Can you tell me if you thought it was easier trading inside of one of those places than it was trading outside?
I think it's a very good question, and I'd have to answer that in a sort of slightly roundabout way. When I joined GS, they had, I think, 120 people in the London office. When I left, I think they had 7,000. So it was a very, very different company over the 15 years I worked there. We saw more flow at Citi. I mean, Citibank back in the late 80s was the number one foreign exchange bank in the world.
Yes.
Um, and uh, Stan Druckenmiller used to trade through them. So was that useful? Bet it was.
Right.
But we weren't a big prop shop. We were predominantly market making. But
Right.
there was good flow information. At GS, just to go back to your question, it was, people may find this hard to believe, there was reasonable information, but there were a lot of Chinese walls. We sat away, the prop group eventually was quite distant from a lot of the flow business. And it's not the sort of thing that we were trying to capture anyway. We weren't really looking to make 20 ticks or in FX or a quarter point on the bond, and the bond business was on a completely different floor, so we wouldn't see any of that stuff anyway. But was it, in the bigger picture, was it useful? I think yes. We had good economists. They had very good connections with big clients, so we were aware of certainly what other people were thinking of the macro space and a 3-month, 6-month view. So was it easier than sitting at home and doing your own work? Absolutely. Was it stealing lollipops from kids? No, it wasn't. So it was a mix. And I think as the firm grew, actually less and less information filtered down. Just as everything, the regulatory environment just increased dramatically. I left shortly before I assume the Volcker rules came in, and the whole thing to a large extent was closed down. But yeah, I mean, absolutely. I'd be lying if I said there wasn't an advantage to some degree of being in an organization that had very good information flows. I don't know if that answers your question.
No, it does. It's more about the fact that they have so many connections and they're speaking to so many people that you're getting so much information. It's not really inside information, but it's information that I personally wouldn't have sitting here. I don't know what Druckenmiller's doing or what these other people, the access to the economists and all that. I can read what these people are saying. But that other kind of information I wouldn't know. That wouldn't necessarily help me too much anyway. But certainly, yeah, that's what you're saying, is that they had so many relationships that they saw a lot of what was going on, and you could get a lot of different views from there. That makes sense. There's nothing inside information about that to me. What always interests me is with macro, okay? Because I've done macro in my life. I still comment on macro, but I do not trade necessarily on what I would call my economic macro views anymore, because I have found, for a number of reasons, it hasn't done me very well. And I'll give you an example as a question. Let's just say, for example, as I was saying before, you came in this year and the market is discounting in 6 rate cuts. Okay. And you, for whatever reason, feel very strongly that there's no way that that's happening. Okay. So you're going to bet against those 6 rate cuts. So as one bet, I'm not saying you would have done this, but let's just go with it. You say, okay, the markets are discounting in 6 rate cuts. The equity markets are very bullish because they believe there's going to be 6 rate cuts. I don't think there's going to be anywhere close to 6 rate cuts. So that would have been the absolute right bet. I don't think there's going to be anywhere close to 6 rate cuts. So if you said that, and in January said, so therefore I'm going to short the stock market, right?
Yeah.
So what happened there was you got the macro. You couldn't have gotten the macro anymore right. Yeah?
Yeah.
But you lost a bunch of money on the trade.
That's a very good example, but the logic there is that you don't think they're going to be 6 rate cuts, so you should express that view via interest rates, not via the stock market. I generally, if I don't trade single stock equities, I don't trade indices, but my track record in trading indices is actually pretty damn poor, so I generally don't trade it. I tend to stick to fixed income. I'd probably 80-90%.
So if you were betting that there weren't going to be 6 rate cuts,
yeah,
then you would have been shorting the short end of the curve.
Yeah, I would futures, absolutely.
Which, quite frankly, the 2-year notes I'm just looking at 102 and change, and now they're 1 point below where they were at the beginning of the year, despite the fact that they were calling for 6 rate cuts then and they're calling for maybe 1 now. So you made 1 full point in 2 years on that trade.
Yeah, perhaps look at you. I don't know, they don't call me Eurodollars anymore, do they? They're called something else now. How old I am.
Yeah, the short end. Yeah,
short end. Go out to the 6th or 8th contract. I'm not in front of my computer right now, but
right. So that would have been more, because that one is clearly pegged to Fed decisions, right? Because that's the shortest one. But what I'm trying to say is, where oftentimes, you can get the macro right, but the market wrong.
Absolutely.
So if you get in that situation, you're trading off the macro view, you put the trade on, you get the macro view totally correct, which is hard enough. but you lose money on the trade. Where do you like cut? What makes you say, okay, I'm getting out of this trade? I'm cutting my loss on this trade. I hear people say it all the time. Oh, I had it totally right. The only thing I had wrong was price, right?
Yeah.
And I'm like, well, that's the only thing that matters at the end of the day, because that's what you're trading. You're not trading. There's no contracts on GDP.
It'd be interesting to turn that argument around. You get the macro wrong, but you get the price right.
Yes, I'd rather do that.
My rules and that sort of stuff is you cut it. Just as you cut the losing position, you cut the winning position, because it's what you thought didn't happen, and yet you're still making money. And that then becomes, you've gone down the rabbit hole. So you've got to be consistent. And to go, if my view is that interest rates should rise and not fall, then I should have an interest rate bet on, not an equity bet or a commodity bet or whatever. You think, and I agree, there's a logic. In fact, I would have said, equities should be lower, and they're not. They trade incredibly well. But this goes back to discipline, I guess. You've got to be disciplined. Why did I get into the trade? What were the reasons? What did I think was going to happen? And you stick to that. Now, where your stop loss is obviously clearly dependent on a whole bunch of factors, but you have to be very disciplined. And actually, I used to keep a very detailed trading diary. I've got stacks of them somewhere. I have to say I don't do that anymore, because certainly a couple of years ago, I don't get up in the morning and spend 6-7 hours in front of the screens anymore. But I do think that was a very useful process. I think it keeps you honest. You look what you wrote yesterday, what you wrote a week ago. I used to print out charts and keep them in there, and it was helpful, and it was a discipline. And I think this job is 99% discipline, frankly.
Totally agree with everything that you said. I have a newsletter now, and really all the newsletter is that goes out to people that subscribe to it is what I had keeping a more detailed trading diary in the years past. But once I've settled on one trading process that I use, all my newsletter is what I've been keeping as my trading diary for the last 20 years. And then I kind of, and I put in there not only my process and my trades, but also my thoughts based on that as to what the macro is. And the only reason I do that is because I get to go back at the end of the year and just see just how freaking stupid and wrong I was, a lot of the time, right? I mean, this is where we learn. So I agree that the trading diary thing is so brutally important, because it keeps you honest. People have a way of gravitating towards remembering when they were right and conveniently forgetting when they were wrong, right?
Yeah.
So if you keep a diary, you can actually go back and see. And I've had plenty of people get on me about this. And I don't mean to make this about me, but it's just as an extension to what you were saying. I've had clients say, "Oh man, you said this and this and this, and you were so right, and you didn't really make a lot of money out of that. Why not?" And I'm like, because you're only seeing the time I was right. You know what I mean? There's plenty of times when I'm wrong on those same things, right? Like I always say, flip a coin, right? Here, heads. Oh, I made heads. Well, why didn't you make a ton of money out of that? Well, because it was a stupid bet. It doesn't mean it wasn't going to be heads or tails. It always was, but it's the same type of thing. And I think that, like you say, keeping a diary keeps you straight and keeps you honest about those things. So I think that's a great piece of advice for people if they want to take this seriously. You've got to develop some kind of diary so that you can go back, if for nothing else, recognize your own stupidity.
Yeah. A funny story for you. My my old boss, which ran, I was having my year-end review, and he said to me, "Christian," he says, "all I want you to do next year, just do the good trades."
Yeah. No, my clients, I get that. I get that all the time. Just trade small during your drawdowns and big when you're making money. Okay, I'll try. You know what I mean? Like, if you could please tell me when my drawdown is going to be, I promise I will trade smaller during that. And if you tell me when my good runs are going to be, I will trade larger during that. Be great, wouldn't it?
Indeed. Oh.
exactly how people think. So what else? I think that advice is great. I think that the idea that this is 99% discipline is great. Why don't we talk about discipline? What does that mean to you?
Um, so that's interesting. What does it mean?
As we hear this all the time, you got to be disciplined. You got to be disciplined. Okay.
I think it's being honest with yourself. It's the one thing I absolutely love about trading is we have a black and white number at the end of each day, end of each week, end of each month, and it you could have been right. I think those 6 rate cuts is silly and it's not going to happen. But if that number is negative, then you've got some difficult questions to answer, and that is certainly part of discipline. It's being honest with yourself. I mean, it is what I fundamentally love about this, that you find out who you are in trading, because there's no bullshit. Basically, if you've lost money, you've lost money. And I'm sure you've heard it. It wasn't my fault. The market did stupid things. It wasn't
I
fair.
hear that all. I've heard that a million times.
And
I still hear it.
and I've probably said it to myself a number of times over the
Yeah,
years.
we all have.
But the discipline is just saying no. That be honest, you were wrong, or you messed up the way you put that trade on, and I just think it makes you learn about yourself. I think you learn a lot about yourself. So it encompasses a lot of different things, but the bulk of it, I think, is about your personality, who you are, how you behave, certainly how you behave in stressful situations, which again, I think that's a very important trait, for traders, is how do you operate under stress? Because we're all going to be under stress at some point. And actually, that's, I think, to a large degree, whether you succeed or fail in this business.
Knowing yourself.
Yeah.
So important. It's so beautiful. Really, that's what this game is about. It's about
And
knowing yourself and somehow trying to get control of your
I don't,
weak behavioral biases.
and I'm sure you'd agree with the best lessons are the painful ones. They're the ones that you remember, and you have to survive those. And I've certainly had some pretty bad runs and drawdowns in my career, but I took a lot away from those. And you have to recognize, the frailties that you have and where your weaknesses are. And I think that just makes you a better trader. Doesn't necessarily
And a better person, quite frankly. But yes, definitely
may not make you a more successful trader. It'll certainly make you a better human being.
Yeah, and it's such a hard thing for people to get. How do you learn how to trade? Well, lose. That's the best way to learn. Lose. Learn how to lose first. I think. I say very often, it's just a matter of staying alive until you can get lucky.
Yeah, you get lucky, or you make. I know that's you make your own luck. Serendipity. I prefer serendipity to making your own luck. Curiosity. You work incredibly hard. You try and find a small edge somewhere, and when you find it, you push it, and when it starts working, you push it more.
So you're a believer in, as your idea starts to work in the market, add to the trade.
That's generally certainly how I used to trade. Absolutely. So there were some trades where I think I started big and then got smaller, but that would be an exception. Generally, it was start small, get bigger if it's working, and it's got, you think it's a 3 to 6 month horizon trade, and you think it's going to go a lot further, and you have good reasons for believing that.
Right. So it's a function of the trade as well, obviously. Right.
And that's where the diary comes in, because you go back and say, why did I put this trade on? What were the reasons behind it? It's because I think 6 rate cuts are silly, and 6 rate cuts are implying 125, 150 basis points. So if the trade has moved 100 basis points, then I think pushing it is probably pretty silly. But if it's 30 or 35 and the data is beginning to back up your original view, then you push it.
Makes a lot of sense. What do you think now? Anything?
I have, as I've told you, I'm not trading actively. My predominant positions, I'm long of commodities and the equity of commodity producers, and I'm actually very comfortable with that position. It's a long-term position. It's not something I don't see. It's not a tradable position. It's essentially the bulk of my pension. But I'm very comfortable, and it's predicated on a bunch of stuff. But I think since the financial crisis, we go back, the Western economies, I think, to all intents and purposes, are essentially bankrupt, massive deficits, underfunded pension liabilities. I don't think inflation's going away anytime soon. Will it go up and down? Of course it will. But I think we've begun a general rising trend in inflation.
Because of all the money printing that's gone on.
Because all the money printing, low interest rates. I mean, I was looking a few weeks ago. I think the Bank of England has some data that goes back. I think it might go back even 300-400 years. We've never had a period of zero or even negative interest rates for as long as we've had them recently, and I have to believe that it's going to have some consequences. And then on top of that, you look at what's happening. All these off-balance sheet items, certainly government pensions, they're huge. I mean, I think the Western world, to a large degree, is essentially bankrupt. And I think these chickens will come home to roost. Now, will it be next year or the year after? Unlikely, but will it be in the next 5 to 10 years? I think so. I mean, it's a very broad brush, and it's I'd say it's a little bit more detailed than that, but I'll be honest with you, I've had this view I started putting this on as a position probably about 5 or 6 years ago. So, it's had, and actually, interesting enough, the equity of these commodity guys has been a terrible trade. It's been absolutely atrocious. The commodities, the physical commodity side's been actually pretty good. And I'm actually at a bit of a loss to understand why the equity side hasn't worked. Because as far as I'm aware, in the research I've done, they don't forward hedge as much as they used to. But that's one of I don't know. I don't understand. But
the way that I've understood that trade, and I don't know if it's right or wrong, but if you're a gold miner and the price of gold goes up a lot, that should be good for you because you have a bunch of gold in the ground that you can dig up, right, and sell for a higher price. But the truth is you need to dig that up, and you can't dig that up in a day. It takes a lot of financing. It takes a lot of equipment. It takes a lot of labor. And I've always been told, if you like the commodity, buy the commodity. Don't buy the commodity stocks. I've always been told that, and I've noticed that actually has been a good idea.
and you're absolutely right. But I have generally, as a trader, tried to short indices because that tends to be, if you're right, that tends to be the quick. It's the easy way to do it. So the rationale behind this, and the larger part of my position is just the commodity. But I thought, you know what, Christian, you've missed out on so many good equity rallies. Buy some equities, and then of course, from a bad equity trader, what do? I buy the miners. So that's perhaps I should go back to my diaries, actually.
Yeah, I think a lot of people have been frustrated by that trade for sure, from what I can tell. But if you have the commodity, then that's working too. Who wins the battle? The governments. I'm no economist, but I do play one on YouTube. The governments are bankrupt. Okay. They are borrowing unbelievable amounts of money. So what they do is they print money.
Mm-hmm.
right? Just like what I would do. If I owned a printing press, I would print as much money as I possibly could until somebody arrested me, right? When are they going to arrest these people? When or do they win? You know what I mean? Do they win? Because that's just the game. I have a friend who tells me whenever I get into this argument with him,
Mm.
um, he's like, I'm like, this whole thing is a Ponzi scheme. He's like, okay, welcome to the real world. It always has been. Why is it any different now than it was before? It's always been a Ponzi scheme. And I can remember, even though I was a young kid, during the Reagan years, we were told the same story. This was in the 80s. Oh, we're borrowing way too much money. And they put the national debt clock up there in New York. And that was the big news. And meanwhile, if you had been shorting the US or the US equity markets or even the US bond markets for that matter, since the Reagan years, you have not done very well. So when do the chickens come home to roost? What's it going to take? How do we know? Because I'm a believer in this. When I go ahead and I make the end of the world super bearish argument, it's all based on that. But they keep doing it and it keeps working.
They keep doing it, but the situation gets worse and worse. You know, what are we, $1 trillion in interest payments now in the US?
Yeah, but what's the number?
I think it's inflation. I think that politicians, here's the other problem. You know, politicians, in the US, you've got a 4-year cycle. In the UK, it's 5. So decisions are all made on that cycle time. Basically, they don't care. They'll print. They'll keep printing and kick the can down the road until it's no longer kickable. That's your question. How do we know when that hits? I think it's when, and I think we're seeing it, we're beginning to see it. I can talk more, certainly from experience here in the UK, it's interest rates and house prices. You know, the UK is, everything in the UK politically is predicated on the house prices. House prices have just been going up and up and up for the last, well, since I bought my first flat in 1989, which was just before the housing market collapsed.
Of course.
I mean, it really did collapse. Interest rates went to 13%.
Right.
But then after that, we've just been, I don't know how many hundreds, if not thousands of percent, house prices have risen. So everyone here, and that's what politicians care about. So they introduce the most ludicrous policies to support housing. And I think that is what inflation picks up. We won't, obviously, the central bank won't be cutting rates. And in fact, so to go to your question, what I think the first substantive thing to look for is when we start seeing interest rate decisions being taken back into the political spectrum, away from the Treasury, away from the Bank of England, which is how it used to be in the early 80s in the UK. It was a political decision to either cut or raise interest rates. That was given away by Gordon Brown in the 80s, actually, in the late 80s, through over to the Bank of England. And that, to me, would be the clearest signal possible that the game is up, basically.
Is when
politicians start deciding what interest rates should be.
Okay, so that means the elimination of the Federal Reserve Board.
Or it means that the structure as it currently stands changes, i.e. the Treasury Secretary gives instructions to the Federal Reserve Board whether they should be cutting or raising interest rates, which is how it used to be. And I said not that long ago, late 80s in the UK. But I think that will be almost necessary. Where if inflation continues to be problematic, because the politicians won't care whether cutting rates is necessary. If inflation's running in double digits, they will just do it. We've seen, certainly we have not that distant history of hyperinflation. Now, I don't want to sit here and sound like I really think the world's coming to an end, but we have that in.
Why not? I do. I can't trade that way, because if I trade that way, then I just lose money and my world comes to an end. But anyway, go ahead.
I think we're the lucky generation. We've had. I feel sorry for my kids because I really think they're stuffed. Actually,
But everybody always says that. I'm just playing the cynic. Here's a few cynical thoughts on all of these thoughts. And I don't disagree with any of them. Okay. But here's the cynical thoughts. Housing. Sat down with my son. He's 26 years old. He's got a good job. His girlfriend, who's his fiance, has a good job. They can't afford a freaking house. Okay. They both have professional jobs. They're making more money than I made when I was 26 years old, especially between the two of them. They live in LA, and he can't even come close to affording a house, right? But when I think about it, I think about where was I when I was in my 20s? Well, I was living in Hong Kong, okay? And at the time, it was the early 90s, and Hong Kong had the most expensive real estate on the planet at the time, right? And I remember looking up at these places on Robinson.
It'll be Japan, I think, actually. Tokyo, probably. But
Japan in the late 80s until that topped, right? But then Hong Kong took over, right? So it was like I used to look at these places on Robinson Road, Dynasty Place, Dynasty something. And like they had 2-bedroom apartments there. And they were like $3 million. And as a 24-year-old kid, I'm like, where the hell am I coming up with $3 million to buy one of these places, right? And it seems so ridiculous and so out of control and so unaffordable. And if you go back to those places now, they're probably $20 million.
Mm-hmm.
Right. And I feel like real estate I've never in my life heard a time where people were running around going, oh my God, real estate is so affordable now. Everyone should go buy a house. I feel like it's never been affordable. And yet it's always gone up. Not always every year, but we're on highs now is what I'm trying to say. So therefore it's always gone up. So that's been my problem. And this has been sort of a big difference in my thinking as I've got older. When I was younger, I was always like, oh, this is ridiculous. But the truth is, as I've got older and I've been able to witness these things, it's the same ridiculousness now that it was 30 years ago. And if you had bought the stuff 30 years ago, you did great.
Well, I go back 30 years or 35 years, and my wife didn't work, but we could afford a place. And I was my first job at Citibank. I think, multiple of wages. I think in those days you could, it was a 2-bedroom flat next to a railway line. And I'm going to say it was 3 times my wage. Whereas now
it's like 7.
Well, now it's like 7, and I think it's higher in the UK.
But again, just to be the cynic, 3 times. Okay. At the time, 3 times maybe seemed like a lot. But you know what? Then it went to 4. Well, that seemed ridiculous compared to 3. Then it went to 5, which seemed ridiculous compared to 3. Then it went to 6, which seemed ridiculous compared to 3. And now it's at 7, which seems ridiculous compared to 3. You know what I mean? So while I get the math of it all, again, just trying to see the other side of it, it's like, well, what if is it going to 8, 9, 10, 11, 12? Because if it's 12 times income, well, then 7 doesn't seem so bad.
The added complicating factor, which I think is a real issue, is that we've had 0% interest rates for how long now? 15 years, pretty much. And they're not anymore. So the actual cost now of funding those mortgages, they call them, I don't know what you call them in the US, is it's got
out of control.
It's out of,
and yet prices don't go down.
Sorry?
And yet prices don't go down.
I think they will. I think they'll stagnate. And actually, I think we're seeing that for the first time here in the UK. I mean, I'm seeing places that have been up for sale in the cities for 18 months now. That was, places used to move within weeks, and they're not anymore.
Right.
And I, we're kind of going around the psychology of people. Well, if I'll just sit here and I'll eventually sell my place because it always works. And it takes something will happen. That psychology will be broken. And if it is, or when it is, it will cascade. It did in the 90s. Yeah, I used to be a part-time lecturer at a business school. This is a long time ago, and I remember giving my example. I bought my flat, that flat by the railway line, and I sold it, including mortgage costs, at an 80% discount to what I paid for it. 4 or 5 years later,
What business school did you lecture at?
it was Imperial College.
No, I went to LBS.
Ah,
Just out of curiosity, but yeah, no, I get it. I get it. But when it comes to the markets, real estate, you can't really do a great job of timing
no,
because it's not liquid enough, right?
exactly. Yeah.
Whereas the markets kind of are. So when it comes to the markets, do you find that, let's equate it. Let's say the real estate market was a liquid market, right? And you think that it's ridiculously overvalued now. Would you be selling it here? Or would you be waiting for the market to kind of confirm that kind of data? Like I have found over my career that no matter what I'm doing, whether I'm thinking in a macro way, whether I'm trading a process, whatever I'm doing, it does me much better to wait for the market to confirm before I put the trade on than it does me to just put the trade on because I think it. How
No,
do you feel?
no, I'd agree with that. I mean, if we're talking real estate, for me, being flat is being short. So
Yes.
I don't think it's a market I'd ever short or want to be short. And we need somewhere to live. So
Right.
unless you're going to rent or stay in a
Yeah, there's
hotel,
huge carrying costs.
yeah. So no is the simple answer. I wouldn't short it. Effectively, I'd say I am short. We owned a lot of property, and we don't anymore. We own the place we live in, and that's it. And that was, it was a bad decision. I made that decision 8, 9 years ago, and it was a pretty poor one, actually.
Well, it was the wrong decision in retrospect.
Yeah.
Doesn't necessarily mean it was a bad decision at the time, right?
I have no regrets, actually. Because it also simplified our lives. So it wasn't primarily actually a financial decision, but all the bits and pieces made sense, and they still do actually to a large degree. So
So give us a couple other secrets to trading, if you can. And given all these different things that we have discussed, let's say my question to you is, what are you seeing now? And what you're seeing is potential calamity on the horizon. Okay.
on the
So
distant horizon, yeah.
on the distant horizon.
Hmm.
So how do I go about trading that? Do I wait? And what am I waiting for? And you know what I mean? And what do I do in the meantime?
I think that big picture view is very difficult to trade. So in the shorter term, I think inflation is something to keep an eye on. I think it's something to keep because I said we're going to see, we're going to see the sideways. Inflation will be rising, and it will be falling, but I think we're going to see that in an upwards trend, and that means that for me, that interest rates, whether it's in the 10 or the 30-year section, are also in general upward trend. I'd watch the dollar. The dollar starts weakening. It's going to tell you, I think those trades are more likely to work. At the moment, the dollar's pretty strong. People will say as interest rates rise, the dollar should strengthen, and that tends to be the knee-jerk reaction. But that, again, to me, would be another sign that we're entering the end game, is when the dollar starts to weaken on higher US interest rates.
Love it. Love it. To me, my whole big call is, if you want to bet the end of the world, you watch for the dollar to go down while interest rates are going up, and the stock market. If all three, stocks, bonds, dollar, all go down when they should theoretically be going up, that's when you put on the end of the world trade, to me. And I'm glad to hear you sort of agree with that,
But
because
there are,
I think,
yeah, and this probably isn't a popular thing to say, but you can see China's divesting itself of US treasuries when and without going into the rights or wrongs, because it's not what we're talking about, but essentially confiscating Russia's assets at the Federal Reserve what message does that send to other countries? What message does it send to India? What message does it send to China? And it's sent the message, and they've received that message, and is we're not particularly happy owning $2 trillion of US Treasuries. So in China, it's dropped dramatically, and I'm pretty certain it'll continue to drop.
But
And
so what? Because the U.S. government just buys them in the whole Ponzi scheme of it all. So who cares? I'm just
well,
being, but
yeah,
who cares? They just
but
print money over here and they buy the things over here. So what? The Ponzi scheme continues.
the Ponzi scheme, well, that is the Ponzi scheme. It wasn't a Ponzi scheme when real countries were buying your debt.
No, it's been a Ponzi scheme to me since the 0809 thing.
Right. Yeah, and I'm not going to disagree with that. But it's another part of the puzzle that's falling into place. And it's going to take time to unwind. And I think people will begin to realize that when things we said, when the dollar starts weakening, when there's a separate payment system set up for non-aligned countries, and they're going to do that.
Right. But then you also have this thing of, there's so much cash out on the side. You got $7 trillion in money market funds out there that are willing to suck up whatever demand or whatever supply of this stuff it is, right? And of course, the reason that you have so much of that out there is because the government's printed money and giving it away, right?
Printing, treasuries, hoovering the cash up. But we go back to 2000. We go back to 2008, 2009. People hadn't heard, or they'd heard of it if you were an economist, quantitative easing, and now everybody knows what it is. We had quantitative tightening, and the Fed's easing off on that. But I do think people are getting more informed. But a lot of this stuff will manifest itself via, I think, prices, inflation. That's where we're going to see it ultimately manifest itself, and politicians are going to find it very difficult. I mean, I think they've been fiddling the numbers anyway for years. That's one of the reasons I think they stopped money supply numbers. Whether it's core PCE, I mean, some of the, excluding food and energy, I laugh, the two things that we need most.
No, it's a joke. It's all a joke. It's a complete joke. Yeah, excluding food and energy, which is really all I need. Right? I mean, if it really gets down to it, what do I need? I need food, I need water, and I need some energy to put my lights on, right? I don't need to buy a new couch. I don't need to buy new clothes, right?
So what I do now, instead of sitting in front of the screen, I'm growing my I say that half jokingly. I am growing my own food, but I do it for different. But it's it beats sitting in front of a screen for 6-7 hours a day.
Yeah. No, I see it. I'm holding back, quite frankly, because if you get me onto the onto the Ponzi scheme rant, it can get pretty ugly around here. But again, for me, the message is this may all be true, but you cannot trade that until at least the markets give you the sign. And you're saying that the first sign could be weakening dollar.
Weakening dollar with a robust interest rate structure. I think that
right. Rates going up and yet the dollar going down.
Yeah.
Because that's the world basically saying, we don't want this shit anymore. You're printing these dollars to support the treasury bond markets and we're done accepting them. It's basically, that's the world saying that, right?
Yep.
I think that's a great point. And I think that's the important point here, as far as macro view goes. And so I'm going to let you go on that because it's not going to get any better than that. So I really appreciate your time.
And yours, John.
I wish you luck in whatever you're doing, growing food and all that. And I God save the Queen. I hope we all we all survive. I hope we all survive this whole thing.
Oh, we will. And I'm hoping markets will return to the sort of days that I remember where I'll find it fun sitting in front of the screens for 6 or 7 hours a day. I keep looking at.
That ain't about the markets. That's about you. I don't find it fun sitting in front of the screen every day, all day, and I still do it because it's my job and it's what I do, and I don't know anything else to do. But truth is, I wouldn't say a guy came to me the other day, bought me coffee, wanted to talk about trading, he was a kid, wanted to get into trading. I said, why do you want to get into trading? He said, I love it. I love trading. I said, listen, everybody loves trading. Okay. It's a vice. Everybody loves drinking and gambling too. Okay. Doesn't mean that it's good for your life. I put it on Twitter actually this morning. I'm like, if someone came to me and said, I love drinking, so I want to be an alcoholic, you'd look at them like they were crazy. But to say, oh, I love trading, so I want to be a trader. I think people are in for, and I used to say that when I was younger too. And it's not that I don't love what I do, but whatever. It's something to think about. And I think that that's what you're saying. You want the markets to get back to a place where you used to love it, but you loved it because you were young and it was exciting and it was,
It's youth is based on the young, but you're
based it on the young. Yeah. All right, good. Well, again, thanks so much for your time.
Jason,
I really enjoyed it. Let's please stay in touch.
I'd love to. Take care.
Hit me up anytime. Anytime you want to talk, I'd love to speak with you. You're a smart guy.
If you're ever in Scotland, come and visit.
Is that where you are, in Scotland?
I'm off the west coast. I'm in a very remote part. So
yeah, no, we're getting over to the UK. My wife is of Irish heritage, so I keep promising her a trip to Ireland. And once I go there, I'm going to spend at least 3 or 4 weeks and just go around. I went to school in London for a year, so I spent some time there. But now my life is all about bringing my wife places. So we're going to get there. And when I do, I will definitely hit you up.
Cool. Take care.
All right. Thanks, man.
Ciao, ciao.
Talk to you again.